Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, investment markets this week have been fairly thin on the ground, and by that I'm talking about the volume we've seen in equity markets. So you may recall in the last couple of weeks we saw a bit of a sell-off and then the markets start to rally higher, and that was on the back of some positive news surrounding jobs numbers that was giving a boost. And then we had a bit of a blip around the possible second wave of the coronavirus around the world. Now, not a lot has changed in the last week. We've still got that same narrative that's playing out. So we've still got the central banks in the background, but we've still got concerns around this second possible coronavirus wave, particularly in the US, but we're also hearing noises about it in the UK. And funnily enough, today, just after the UK announced some lowering of the restrictions surrounding the coronavirus lockdown in the coming weeks, the market has actually pulled back. And some of that is probably wrapped up in concerns about whether we will get a second spike in the UK, as some of the medical experts are suggesting. But there has been another narrative that suddenly burst on the scenes this week. Now, if you go back to yesterday, then in the early hours of the morning, UK time, so this was during the day over in America, one of Donald Trump's advisors, Peter Navarro, actually made a statement which suggested that the US-China trade truce, the deal, was no longer in effect. It had crumbled. And of course, the market took that very badly. Now, Donald Trump was very quick to take to Twitter to confirm that everything was still in place and the US and China trade truce was not about to crumble. So the market breathed a sigh of relief and then continued on its seemingly relentless march higher. Now, today we've had a slightly different trade narrative where there has been headlines that have broken about the US mulling over new tariffs on £3 billion worth of European goods. So that's caused another jitter in the markets. If you look at equity markets today, they've actually fallen, which seems surprising because we haven't seen the market slump really for the last week or two. And the S&P 500, as I look at it, is down 1.76%. So it's down towards the 3,076 level. Now, when we're looking at this, one level to keep in mind is that 200-day moving average, which is 3,020. Roughly, that's what you want to look at. If we break below that, that would be a negative sign. It doesn't mean the market's about to collapse, as I'll come on to in a second. But the FTSE 100 is down 2.3%. The German DAX is down 2.3% as well. And we're seeing bonds being bought, which means that their yield has slightly come down. But if we go back to a week ago, then the market is broadly where it was then. We've had some ups and downs, but as I said, the volumes have been fairly thin. It's almost as if the market is getting to a very elevated level, like climbing a mountain, and the air's getting a little bit thin, and now not a lot is going on because it's running out of energy. So it'll be interesting to see what happens in this sell-off because it's only a one-day blip at the moment. Will it become more? And as I say, look at those levels, those key levels. The 200-day moving average is one of them on the S&P 500. But if you look further down, the market is unlikely to unravel completely until we get down below, say, 2,800 on the S&P 500. So that would probably send the market into a much bigger slump. And that's still because the market believes the Fed has got its back. So the US Federal Reserve is printing money. Interest rates are going to stay lower for longer. And so they've pretty much backstopped the market. So everybody's gone from that fear that you saw into the lows of March. They are still in that buy the dip mentality. And of course, you'll see, if you look at the press at the moment, you'll see lots of headlines around Robin Hood traders. And now Robin Hood traders, it's really a general term that describes a lot of speculative trading that's going on in America through commission-free brokers. So if you think about it, there are a lot of people out there who may have received checks effectively from the US government as part of their coronavirus efforts to try and boost the economy, which people are now just speculating on the stock market. And there are some reports and analysts suggesting that the absence of certain sports that they may be able to bet on has fueled that. But basically, you give people free money, then some of them are going to speculate it. And it seems to be that it's entering into particular stocks. And now, if you look at it, what's quite interesting is the Robin Hood traders who are being blamed for this almost parabolic rise in the US stock market, particularly in the last few weeks. They've tended to favour those stocks that are almost bankrupt. If you remember Hertz, the car rental company, they've been piling into that. They've been piling into airline stocks as well, the stocks of cruise companies. So they have been attracted to stocks that are very low priced, almost worthless at times, hoping to make a quick buck. If there is a bit of an increase, they can quickly double their money. And that's fueling this sort of speculative trading we're seeing. But interestingly, at the same time, they're also buying these quality stocks, the growth stories, which are the things like Apple. And Apple just hit another all-time high this week. And a lot of the tech stocks that are out there, particularly some of the sort of stay-at-home tech stocks we saw that have benefited during the lockdown. So Amazon, Zoom. And so we're getting this kind of two ends of the market that they're buying. It's fueling this rally. So how long could it last? Some of that may be down to whether the US government starts to give them even more checks to perhaps speculate with. And don't be surprised if that happens. After all, Donald Trump has got to try and win an election later in the year. And he needs the stock market to be buoyant, particularly if the US economy is starting to struggle. But the market has had some ups and downs this week. I mean, I mentioned the most recent one as people are starting to worry a little bit about the trade war story again. Of course, this second wave or potential second wave of the coronavirus, but it hasn't really impacted the market too much. During the week, there were some very positive PMI numbers. So basically some economic numbers that came out looking at the potential growth of the various economies in Europe in particular that showed some V-shaped recovery hopes in there, and the markets rallied as a result. We saw quite an aggressive rally this week, in fact. But if you go back and get your app out on your phone, and if you look at your stock app and you go and click on the S&P 500, so the American stock market, if you do that now, have a look at the 6-month time frame. So you can click on the 6-month time frame and it will pull up the chart. What you'll see is from the low in March, there's been a steady increase that's gone up. We've had some pullbacks along the way, but there is a trend line which the rally is effectively bouncing along. And so until we break below that, then these pullbacks we're seeing, they're hitting that support line and bouncing higher. Until we break below that, then it's unlikely that this rally is going to crumble. So that's why it's interesting to see what happens in the next day or two. If we are just going to see the market bounce off that trend line upwards once again, or whether it actually unfolds into something a little bit more. And if it does continue to go upwards, then we'll be looking at the all-time highs again on the S&P 500. If we break back above 3,200 and the recent highs we had in June, which were around about 3,250, then that opens the door to 3,400. Of course, on the FTSE 100, we're still a long, long way from the all-time highs. The all-time highs were way back in 2018. So we've got a long way to go, but we're going to be looking at those recent highs we had, 6,500. As I said, it's around about 6,160 as I make this podcast. So we're still some way from that. What is interesting is, again, if you look at bond markets, we had the bond markets weaken and sell off. So people were starting to take more risk in their portfolios, suggesting that bond markets might start to slump. But bond markets themselves have found a footing, and we've started to see bonds hold and start to strengthen once again. So the story is that certain haven assets like bonds aren't buying what the equity market is selling. And if you look at the gold market, the gold price continues to push high. And in fact, we had a recent 8-year high this week. So if you look at it, there's some mixed messages out there in the market. And although breadth has been improving, I talk a lot about this breadth in the market across the board, but particularly looking at the US market, because the rest of the world does tend to take a bit of a lead from the US market. The breadth has improved. You need that to improve. So that means the number of stocks that are, for example, closing above their 200-day moving average, so their own 200-day moving average. The more and more stocks that do that, the more and more that are taking part in the rally, the more and more that are pushing it onwards. So you want to see that improve, but it's kind of started to stall a little bit. And if you look at it from a historical context, you'd probably hope to see it be a little bit higher in terms of the percentage stocks that are above their 200-day moving average than where we are right now, given the scale of the comeback. We still see at the moment that this rally is being driven by the few rather than the many when it comes to stocks. So the coming days and weeks ahead, we're still going to have this narrative. We're still going to have this coronavirus narrative, and we're going to still be probably looking around the trade war again. But what will be interesting as we move into July, we're going to get the next earnings season start up, and we're going to get more insight into how companies are coping with the coronavirus, or how they coped, I should say, with the coronavirus pandemic and lockdown, and how it's going to impact their earnings going forwards as well. And that might cause a bit of a wobble in equity markets. So it's plenty to watch out for in the coming days and weeks. It's very interesting. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien at moneytothemasses.com is the email address. Money2 with the number 2, the masses, is the Twitter handle. You can find me on Instagram, YouTube, and of course you can find us on Facebook. Don't forget to join our Facebook community. You can find that at facebook.com/groups/money to the masses.